Three investment trade-offs to consider when building a balanced portfolio. Welcome and thank you for joining us. I'm Patrick Seaman with Seaman Retirement Planning. So jumping right in, you may or may not know this, but every investment option, whether you're talking about stocks, bonds, gold, cryptocurrency, mutual funds, money at the bank, any investment option has three trade-offs that would be helpful to know before you're really investing in any of those. Now, everyone has, their individual circumstances and goals, whether you're retired, about to retire, 20 years away from retirement, or whether you have $100,000 or $1 million. These three trade-offs are important to know and understand in order to build a well-balanced portfolio that meets your individual goals. So today, I'm really excited. I have Mr. Tony Parish with me to discuss these three trade-offs. Tony is the Chief Investment Officer of Alphastar Capital Management out of Charlotte, North Carolina. They manage about $2 billion in assets. Tony, how are you doing today?
Pat, I'm doing great. As one guy with sharp-looking glasses to another guy with sharp-looking glasses, I'm happy to be here today.
I'm glad you consider them sharp. I feel so honored. So, maybe you could start off just tell me a little bit about what it's like being the chief investment officer of a company like Alphastar.
Sure. Yeah. I mean, it's great. No 2 days are the same. I'm part of an investment team. We do a lot of trading. We follow the capital markets. We manage portfolios for over 10,000 accounts. We've got a lot going on. We're juggling a lot of things at any given time. So whether it's all of the activities in the capital markets that are keeping us busy, or all the trading activities that are keeping us busy, or trying to stay on top of the next portfolio management decisions that are keeping us busy, there's plenty to do every day, and that's one of the reasons it's exciting.
That's great. What type of investments do you typically work with, or different types of maybe management strategies? Maybe you could talk a little bit about that.
Sure. We in-house, we mostly manage what I would consider to be traditional asset classes, traditional investments. These are the public markets, so public stocks, bonds, some commodities and currencies. However, our clients also at times need access to alternative investments or private markets, whether it's private credit, private real estate, private equity, etc. And for those, we lean on third-party money managers to curate what we consider to be the best strategies in those areas of the private markets. So in-house, we focus primarily on public markets, and then for the private markets, we lean on third parties.
I think one thing I really like about AlphaStar, and it's just that offering, the different things that you provide to our clients, whether it is private equity or just kind of a balanced, diversified stock bond portfolio. It seems to me that we have quite a significant number of offerings in order to be able to meet our clients' goals. Now,
Yeah,
I know
I
you
mean,
and
no two households are the same. So different households require different investment vehicles to accomplish their goals. That's why we have to curate a very broad suite of investment solutions so that whatever the client situation is, we have the right tools for them.
Now, I know you and I have discussed these three trade-offs that we're going to go into, and I personally go over them with a lot of my clients from day to day. And if I remember correctly, they're really like a trilogy. They go together like baseball. That is, if you don't get them right, three strikes, you're out, right? So I thought maybe you could kind of describe what they are in your own three-dimensional way.
Okay, thank you for setting up the three paradigm for me to work within.
Yeah.
Yeah, the three trade-offs for investing really involves prosperity, liquidity, and certainty. Prosperity is to invest in something and know that it can grow at a substantial rate. Liquidity is the ability to move in or out of that position without moving the market, without having any penalty. And then certainty is the ability to know in advance what the outcome is going to be. And there are various degrees of prosperity, liquidity, and certainty, but maybe a couple of examples are in order. Stocks, for instance, public stocks. If you invest in, Microsoft or Berkshire Hathaway or Amazon or whatever you're holding, you've got tremendous prosperity, that is the ability to grow. You've got tremendous liquidity. You can sell out of that position any day that the capital markets are open. But do you have certainty in advance as to what the outcome is going to be? No, obviously you don't. Those stocks can go to the moon. They could also theoretically go to zero. So it's wide open as to what the certainty is. So you've got a trade-off there. You can have two out of the three things, but you can't have all three. I'll give you another example. Bonds. Um, Bonds are very good with respect to liquidity. You can own a corporate bond of, let's say, IBM, whatever the case is. Um, You've got the liquidity. You can buy it any day the bond market's open, sell it any day the bond market's open, and you have relative certainty. That is, you can invest in it, and if you hold it to maturity, you'll get par back, and you'll receive a coupon on a predetermined period. You know what the coupon is going to be. You know when it's going to be paid. It has a high degree of liquidity and certainty. But are you going to have a lot of prosperity just investing in bonds? No,
Probably
you
not.
won't.
Right.
You've got two out of the three, not all three. Then you've got things like structured products or insurance products, for instance, that generally have a pretty good amount of prosperity if they're linked to an underlying index, and they have a pretty good amount of certainty. You have a tighter spectrum of possible outcomes if you hold it for the full term, but you don't have a lot of liquidity. Typically, you will pay a penalty if you need to redeem your investment prior to the end of the term. So
Yeah.
when I was growing up, I used to run with a group of teenage boys, and we used to wrench on motorcycles. We try and hot rod them, and we used to say, there's speed, there's reliability, and there's cost. You can have something that is fast and reliable, but it's going to cost a lot of money. You can have something that's reliable and expensive, or reliable and cheap, I should say, but it's not going to be very fast. Or you have something that's very fast and cheap, but it's not going to be reliable. It's the same kind of thing here,
Yeah.
where you've got prosperity, liquidity, certainty. You can generally get two out of those three things, but you can't get all three in any one investment vehicle.
I think it's really a great analogy. I'd like to add, I know there's some caveats to everything we discuss, and one of the things I was thinking about when you were talking about stocks is you talked about the prosperity and the liquidity, but no certainty. By the way, I
Mhm.
like to use protection, but certainty, protection. Sometimes I use growth instead of prosperity. But
Mhm.
I
Yeah,
think one caveat around that is the liquidity, and that, yeah, you can buy and you can sell those stocks whenever you want. So in that sense, they're liquid. But at the same time, if the stock market's down 20, 30, 40%, is that something you really want to sell? So is it truly liquid? Is it something you would go to because you need money? I would hope not. So I think liquidity is in the mind of the beholder, I guess, in that sense.
sure.
And then you look at structured notes, and as you said, if we're looking at a 3, 4, 5 year note, they're really set up that you would hold those to maturity. But there is a market typically out there that you can sell them, and I've done that. And actually, I was surprised the penalties weren't that bad, but that's probably not always going to be the case. So kind of a buyer
Mhm.
beware thing. Um,
Yeah, there are certain exceptions, but going into the investment, at the point of actually making the investment, those are the considerations to talk about.
yes.
Would you want to sell when your stock is down 20%? Probably not, but theoretically, there is liquidity in place. Will you plan on selling your structured note prior to maturity? Probably not. Although, if you do, find yourself in a position where you have to sell, you may find that there is a reasonable amount of liquidity. You shouldn't count on it, but it might be there.
Yeah. Another type of investment that we work with is a fixed indexed annuity through an insurance company.
Mhm,
And it's a similar type of investment product to the structured note, but it's through an
mhm,
insurance company. And I like to always look at that and contrast that to a bank, where a bank, you have that safety, you have that principal protection, you have the liquidity typically with money at the bank, but you have very little or almost no prosperity or potential for growth.
mhm.
Um, Versus an indexed annuity might kind of bridge the gap between, or the difference between something like money at the bank and the stock market, in that they can certainly give you a greater opportunity for growth or prosperity. Um, you have that safety or principal protection that the insurance company guarantees, but where it lacks is the liquidity. Typically,
Yeah.
they'll let you take out 10% without penalty, but they're typically last 5, 7, up to 10 years long. And if you need your money, need it all, you're going to pay a significant penalty. So it's something we would use with a client, but it's something that we do it in a limited fashion because of that liquidity aspect.
Yeah.
Um, so, when we're beginning to build our portfolios, one of the things we're always looking for is diversification. And that, diversification really tries to reduce the risk in your portfolio by, having a lot of different, types of investments that,
Mhm.
are going to perform differently over time. So, how do you take that in consideration when you think you're trying to build that truly diversified portfolio? How do you take into consideration those trade-offs?
Yeah, well, actually, knowing those trade-offs helps to decide what are the appropriate and suitable investment choices when you're trying to build an investment portfolio. For instance, a lot of investors need a combination of things. They want to grow their assets over time, but they also need some liquidity and income while they're doing it. And knowing that there are certain types of assets that are going to be better at growing your wealth, such as stocks, and other types of assets that are better for providing income, such as structured notes or bonds or index annuities with an insurance rider, with an income rider, excuse me. Knowing those things allows us to determine what are how do we use the trade-offs when working to build a diversified portfolio. The thing about diversification is it's really meant to be um, a mitigation against drawdown or to mitigate losses. That's really why we use diversification. I mean, if the markets are going up, you don't need diversification. You actually want to have concentration in the positions that are going up the most. It's in the uncertain markets and when markets are going down that you want to have diversification so as to have some investment vehicles that buffer the volatility that the rest of the market is experiencing. So diversification is great from a risk mitigation standpoint, and understanding what the trade-offs are help to determine what are the right choices in putting
Sure.
together a well-diversified portfolio.
And another thing I think about is when we're in our planning process, we do a lot of income planning for our clients. So they're near retirement or already retired, and we're looking out over the next 10, 15, 20 years. And I think those trade-offs are something we begin to kind of look at in that we look at the money they're going to need over the next 5 years. Obviously, they need to be a little bit more liquid. They need have a little bit more certainty. So prosperity, is not necessarily going to be there. But if you look at what they're going to need in, the 6 to 10 year period, or even beyond that, then you would take that into consideration, and maybe can take a little bit more risk, have a little less certainty, with the option that you can get a little bit more growth.
Yeah, I love that idea. That idea that we look out at an investment time horizon, and then we can bucket the different time periods into grouping of years, and then build portfolios that are suitable for that period of time. For instance, I asked the question, if you knew that you needed access to your entire nest egg in 12 months, would you put the entire nest egg in the stock market? Probably
No.
not. The stock market could drop 50, 60% theoretically over that period of time. Um, and the contrast is if you knew you didn't need access to any of your assets for more than 10 years, would you keep all of those assets in cash or CDs at the bank? Probably not, unless you were independently wealthy and you were just looking to, preserve your capital. You didn't care about inflation or anything else. You probably wouldn't. So we can extrapolate from that logic and say the amount of time that you expect before you need access to the funds ought to be related to the types of investments that you choose for that bucket of assets. So we've built certain model portfolios where if clients need access to their assets in the first 5 years, they'll invest in a conservative bucket whose goal it is to beat inflation. If they don't need access to their assets for 10 years or beyond, they'll invest in a very aggressive portfolio that may have a lot of volatility over the next 10 years, but we expect in 10 years and beyond, it will have grown significantly in value. And if folks need access to their assets in years 5 through 10, we have a moderate portfolio, a balanced portfolio that manages the trade-off between growth and capital preservation at the same time. And so clients that are investing for the long term can work with their advisors, such as Seaman Retirement, to be able to determine what is the appropriate amount of assets within the client's investment portfolio to invest in buckets one, two, or three. Makes a lot of sense.
Yeah, it does. And I think this really dovetails nicely into what we do when we're tax planning. So when we're talking about tax planning, our goal is to minimize taxes over someone's lifetime, not necessarily just today, but we're looking out 5, 10, 15 years. And if we can kind of reallocate their assets in a certain way, apply these tax planning strategies, the goal is, maybe we can save them tens, maybe even hundreds of thousands of dollars in taxes. An example of that would be doing what we call Roth conversion, where we're taking money in a client's IRA and transferring portions of it, probably over several years, with the idea that you're going to pay tax now,
Mhm.
but hopefully taxes won't be greater later on. But we kind of think taxes are going to be a little bit greater later on. And so we have the opportunity to kind of get that money out of their IRA now at a tax rate, a certain tax rate that we know it's going to be, and then in the future, taxes will be low or be higher, and that we will potentially save them some tax dollars. But it's interesting because then you kind of take what we've been talking about and thinking about that time horizon of when they're going to need that money. And if we're putting in money into a Roth, we know that that money in a Roth is going to grow tax-free, which is, mind-blowing. Not only is it tax-free for them, but they can leave it to their heirs, at least the way the laws are set up right now, where they can continue that tax-free growth for another 10 years. So you're looking at an investment in a Roth. That's great money to leave to your kids. And it could be a situation where it's invested for 15, 20, 30, even 40 years. And when
Mhm.
you think about that, you go, well, where can I get the greatest return? Because that return, you're not going to pay a penny on tax on that return.
Mhm. Yep.
So those would be the situations where you would look at something and you look at those trade-offs and you go, yeah, why not just go ahead and invest in something that doesn't have that certainty, but has that prosperity.
Yeah, boy, taxes, we could spend a whole hour just talking about
Sure.
taxes. Personally, I love the Roth IRA as an investment vehicle. You have your money, you pay taxes on that money, prior to investing in the Roth, but then the Roth can grow tax-free. And that's a fantastic vehicle, especially for folks that have long investment time horizons where the growth in their assets could be substantial relative to the initial investment. By contrast, we've got the traditional IRA or the rollover IRA where people have a 401k and then they leave that plan, they roll it over to an IRA. All of that money is invested in the traditional IRA tax free. You haven't paid it, it's sorry, I should say pre-tax. You haven't paid tax on that. However, as those assets grow, when it comes time to liquidate those assets, taxes are owed at that time. As I like to say, an IRA is an IOU to the IRS. Right? An IRA is
Absolutely.
an IOU to the IRS. So how do you minimize that? You can minimize it in a couple of ways. One is to pay the taxes up front, invest in your post-tax assets in a Roth vehicle or another type of vehicle. And another way to do that is through smart tax management in the form of tax loss harvesting, which we do in all of the models that we manage internally.
Right.
So there's a tremendous way to make a difference on the final value of the assets that the clients have in the decisions about how to handle the tax consequences. As the old expression goes, it's not what you make, it's what you keep. And taxes are a big part of that consideration.
Right. Well, I want to thank you, Tony, for taking the time to be with us today, but our time is up, unfortunately. If any of you that have been watching this have any questions or thoughts, please let us know. Email us, give me a call. And we really hope this webinar was helpful. We thank you so much for taking the time to be with us today. And with that, I'd like to conclude this. And until next time, thank you for joining us.
Thank you.